Hello everyone, and welcome to this new weekly episode. This week's episode, episode 15, will be all about draw on liquidity. In this video, we'll discuss everything related to draw on liquidity, including its types, importances, and most importantly, how to actually determine it. All of these topics will be covered in this video, and I'll also provide plenty of examples so that you can thoroughly understand the concept of draw on liquidity. This is a very important topic, and it hasn't been discussed much, so my goal is to clear up any major misconceptions and confusions around it. By the end, you'll have a strong understanding of what draw on liquidity means and represents. First, we're actually going to begin with an introduction to draw on liquidity, what it is, and what it actually means. Draw on liquidity, also known as directional bias, involves understanding and predicting where the market is likely headed and identifying the most probable targets based on the time frame that you are analysing. Draw on liquidity, or directional bias, is essential to your analysis and should be your first and primary focus. By understanding draw on liquidity, you'll have a clear sense of where the market is moving, allowing you to position yourself accurately in that direction. All the other aspects of analysis, such as trade setups, entry models, and narrative building, rely on clear directional bias and strong understanding of the market's draw on liquidity. If you don't know where the market is headed, no amount of narrative building or entry model analysis will be effective. It would just simply be pattern trading, which lacks logical grounding. The first and most crucial step is to determine where the market is drawn to. Only then can you proceed with the rest of your analysis. Narrative building and entry models are all based on having a clear directional bias and a defined draw on liquidity. Without draw on liquidity, these approaches become redundant and ineffective. Without a clear directional bias, you're essentially pattern trading, which is not a recommended approach and should be avoided in your trading strategy. Moving on to the next slide, let's discuss the importance of having a clear directional bias and understanding where the market's draw on liquidity lies. The first and most crucial aspect of draw on liquidity is that it helps you understand what the market wants to do, where it's headed, rather than where you want it to go or where you sense it might go. This removes emotional and sentimental biases, keeping your approach objective and focused so you're always mechanically driven in your decisions. This will make your trading decisions more informed and accurate. With the correct draw on liquidity, you'll be properly aligned with the market, significantly improving your trading decisions and ideas. Knowing the draw on liquidity allows you to align with the market's direction, ensuring you only take entries that form in the direction of the higher timeframes draw on liquidity. Having a clear directional bias in the market greatly increases your odds of success and improves your win rate, as you're trading in the market's natural direction rather than counter trades, which tends to reduce your win rate. Draw on liquidity and directional bias acts as a filter, allowing you to only focus on trades in one direction until the market dynamics and directional bias shift. This way, you'll avoid trades in the opposite direction, which are likely to be of lower probability. It helps you sidestep unnecessary or lower probability setups that might look appealing at first, but go against the market's natural flow, reducing the risk of potential losses. Sometimes, entry setups or models may look appealing and meet many confluences, and you may build a solid narrative around them, but if they don't align with the higher timeframes draw on liquidity, they're likely to be unsuccessful. You could have the most precise analysis, the best entry setup, and a compelling narrative, But if the trade isn't in the direction of the high time frame draw on liquidity, it's not likely to work out. What all of this means is that draw on liquidity is the most important aspect of analysis and execution. Everything else is secondary. In my trade breakdowns, you'll notice that I often focus on determining the draw on liquidity and directional bias because I know how crucial this aspect is to my analysis and execution. I can have everything else in place, but without this aspect, all my efforts become redundant. For your analysis, the top priority should be accurately determining your draw on liquidity and having a clear directional bias. That way, on the lower timeframes, you can focus on trades aligned with that direction. Even ICT often emphasizes directional bias and draw on liquidity, which shows just how important it is. Now, I personally don't take partials or scale into positions, as I'm an intraday trader and prefer to enter and exit within a single day. If I am in a swing trade, I will scale in and out of positions. Also, for swing traders or those who scale into positions, draw on liquidity is invaluable. With a correct directional bias, you can place your stop loss at protected highs and lows and scale into positions as price moves towards your draw on liquidity, yielding greater profits. Although it's a more complex process with multiple variables, having the right draw on liquidity enables more objective position scaling, which can be highly profitable. Another benefit of draw on liquidity is that it simplifies decision making in analysis, entry setups, and narrative building. It reduces conflicting signals and allows you to act with clarity and conviction in your system. If you know the market's direction, you'll be more confident and objective and won't panic if price briefly moves counter to your position. Understanding that the larger picture points towards your target in the long term, even with short-term retracements. These are some of the key benefits of knowing where the market is headed with draw on liquidity. As I mentioned, this should be your first priority when analyzing and learning. Everything else, like finding entry models and building narratives, revolves around this concept. Once you have this foundation, the rest becomes much easier. Moving on, let's discuss the types of draw on liquidity. There are in fact two types of draw on liquidity. For many, this might be the first time hearing that draw on liquidity even has types. But it is true. Not many people talk about this or even are aware of it. I've come to understand and identify these types through my own research, experience, and chart studies. In this part of the video, I'll explain each type of draw on liquidity, what they represent, their core differences, and the specific purpose each serves. The first type is short-term draw on liquidity, and the second type is long-term draw on liquidity. By their names, you might already have an idea of the general concept behind each, but remember, it's not that simple. Each has a range of nuances and details that you need to be familiar with, which will ultimately help you make more informed decisions about where to look for trades and where the market is likely heading. Let's move on to the first type of draw on liquidity, which is short-term draw on liquidity. Simply put, short-term draw on liquidity or directional bias helps you identify where retracement profiles and shorter moves might occur or end. In other words, short-term draw on liquidity is used to determine where the market is initially drawn to within the immediate price action and time frame. Now let me explain further. We know that the market moves within profiles, with 5 different types, each having specific characteristics and potential outcomes when combined with key levels and dealing ranges. Suppose our target is higher, or we expect the market to reach a higher time frame key level, or we expect the market to reach a key level on the higher time frame, meaning our draw on liquidity is higher. In reality, the market will not move directly to that goal or target. It moves towards it in phases or profiles. Even if the draw on liquidity target is higher, the market will make retracement profiles in the opposite direction, rejecting lower levels in a bullish order flow or higher levels in a bearish order flow. These retracement profiles are essential to rebalance expansion swings and ranges. For example, it might reject the lows in bullish institutional order flow to clear out counter liquidity and create new momentum before moving higher. This movement pattern is part of the market dynamics, and as I covered in the chapter on order flow and market profiles, I'm sure that you now understand that the market never moves in a straight line. Let's say, for instance, that we determine our target or goal is to move higher, either to take out a swing high or reach a higher time frame key level. Our objective here would be to look for longs, but we also need to recognize that even if the market wants to go higher, it will likely make retracement profiles lower and counter moves to reject below lows before moving higher. If we analyze price action and see we're somewhere between key levels, the first thing to do is to expect a retracement profile or a move down to a discount level, at which point we would look for long positions. If we analyze that the price action is somewhere between key levels, the first thing to expect is a retracement profile or a move to a discount level, at which point we would look for longs. This is where the short-term draw on liquidity actually helps. It shows where the price might retrace before expanding higher. If you identify that the market first wants to retrace lower before moving up, you can look for short positions toward the short-term draw on liquidity, and once reached, then look for longs. This is the core idea of short-term draw on liquidity. For example, when day trading, short-term draw on liquidity helps pinpoint where the market will likely make an initial move, like a liquidity purge or an initial target, before making the major move. Short-term draw on liquidity gives clarity on where the price might pause or reverse before continuing to the bigger long-term draw on liquidity. Another key point is that short-term draw on liquidity reinforces your confidence in the long-term draw on liquidity. When you're aware of short-term draw on liquidity, you understand that the counter moves are normal and shouldn't cause alarm. If you weren't aware of this concept, any price movement in the opposite direction of your long-term draw on liquidity could cause panic, possibly leading you to shift your draw on liquidity and distort your analysis. With an understanding of short-term draw on liquidity, you know it's normal for price to reject certain levels and make retracement profiles before progressing towards the higher time frame objective. You'll start treating these counter moves as rejections rather than structural shifts, gaining a clearer understanding of market dynamics. Now let's move on to the next slide and take a look at some visuals to explain short-term draw on liquidity. Here we have this chart. We can see that we started by testing a key level here, purging below this low, and since then we've been moving in a bullish order flow, consistently making higher highs and higher lows. The market's in a bullish order flow because it's rejecting below lows and breaking above highs. In this case, we almost reached the draw on liquidity, which is higher at this key level sitting above us. However, the market then moved a bit lower, bringing us to this point right here. If you weren't aware of short-term draw on liquidity, you might have looked for long positions immediately from this point. But since you understand short-term draw on liquidity, you know that our first and immediate draw on liquidity, known as short-term draw on liquidity, is this low right here. We first look for the price to reject below this low to take out liquidity, purge and manipulate counter liquidity before expanding higher towards the major draw on liquidity sitting above. In this scenario, you would first expect the price to purge below this low, reject below it, and then break above this high to test the key level. That should be your first response. This is what we call short-term draw on liquidity. Even when our long-term and high time frame objective is bullish and aimed at reaching this higher time frame level, we still look for price to move lower because we know the market moves in profiles and objective order flow before reaching its final target. Before it can reach there, it first has to reject below, and determining where this retracement profile might end is what we call short-term draw on liquidity. Let's see what happens next. Here you can see what unfolds. First, price came down to take out the low and reject below it, forming a retracement profile. This retracement profile ended when we reached the short-term draw on liquidity. After that, price started expanding higher towards the long-term draw on liquidity. To some of you, this might seem a bit vague, so let me explain its importance. Let's assume we're looking at the weekly chart here, and this graphic represents the weekly timeframe's price action. From this, you can imagine, or likely guess, each of these swings represent at least 1 to 2 weeks of data and at least 200 to 300 pips of price action. Remember that framework. Now that amount of price action on a lower time frame would be substantial. So let's say you weren't aware of short-term draw on liquidity and only knew about general draw on liquidity or directional bias. Let's say you determined order flow here, saw it was bullish, and identified your target as being higher. Now when we were at this point here, like you did see on the previous slide, you might have immediately started looking for longs on the lower time frame because you determined your draw on liquidity to be higher. Throughout all of this price action that occurred over the week, your draw on liquidity on the lower time frame would have been off as you kept looking for longs and weren't aware of the short-term draw on liquidity, which was the first priority before reaching the long-term draw. In this case, you would have been wrong throughout the week on the lower time frame as your expectation was bullish, while the price action wanted to go lower to take out the short-term draw on liquidity first, reject it, purge below the low, and then expand towards the major draw on liquidity set above. This highlights the importance of short-term DOL. Many traders struggle with this, leading to repeated losses and incorrect draw on liquidity on both the lower and higher timeframes because they aren't aware of the different types of draw on liquidity. This is the reality of the markets and what short-term draw on liquidity is. Knowing where the price is likely to go first to make its immediate short-term move before making the major move towards the long-term draw on liquidity. Once that short-term draw on liquidity is reached, your priority then shifts to the long-term draw on liquidity. Here's another example to explain even further. Here you can see the euro versus the US dollar daily chart. Based on this, you can assume that each candle represents 1 day of price action. In this example, we observe a bullish order flow and our long-term draw on liquidity is higher, represented by this high. The order flow is bullish because the price is consistently rejecting below lows and breaking above highs, indicating a bullish order flow. In a bullish order flow, our draw on liquidity is generally higher. So in this case, our main draw on liquidity or objective is the high that we are aiming to reach. This represents the typical draw on liquidity you're already familiar with. However, before price reaches that high, it has to form a retracement profile and then complete that profile before making a major move higher. Here, you can see that we have this low, and below it is an order block within the discount region. Now, we know that before the price expands higher, it first has to reject and purge below this low and the order block before it begins moving higher towards the main long-term draw on liquidity or objective. This is what short-term draw on liquidity helps us to understand, where the immediate initial move could occur before the major move. Moving on to the next slide, here you can see that the first thing price did was come down below to purge the low and then ended the retracement profile there, reaching the short-term draw on liquidity to test the key level in the discount region before moving higher. That's what happened. Price didn't immediately start moving higher, but instead ended the retracement profile by rejecting below the low and testing the discount level. Then, after that, it began its journey upward. Without an understanding of short-term draw on liquidity, you might have looked for longs immediately, which would have caused you to interpret price movements and draw on liquidity over these days, resulting in losses. You would have been confused, thinking you had determined everything correctly, yet price moved lower. You might have believed the price was heading higher, only to be thrown off when price closed below this low, mistaking it as a market structure shift and possibly starting to look for new shorts. Then, as price began moving higher towards the original draw on liquidity, you'd be left wondering what went wrong. This is a common thought process in these scenarios. Now that you understand the short-term draw on liquidity and the types of draw on liquidity, you won't struggle with this problem anymore. You'll be far more informed and accurate in your decision making. Here is another example. We have the euro versus the US dollar daily chart, and as you can see, based on range dynamics, we first took out the range low, and now we need to take out the range high, which represents our long-term draw on liquidity. In this scenario, those who aren't familiar with short-term draw on liquidity might immediately start looking for higher prices and seek longs on lower timeframes, trying to find bullish entry models. However, as an informed trader, we know that price always moves in profiles and follows a structured order flow. Before price can move higher towards the long-term objective, it must form a retracement profile to rebalance the range and test the discount key level, which serves as our short-term draw on liquidity. Moving on, you can see that by dividing this entire range, we create a dealing range that includes both discount and premium regions, each with its own respective key levels. Down here, we have a discount fair value gap. Now we know before the price can expand higher, it must form a retracement profile and retrace down towards the short-term draw on liquidity, making its initial and immediate move before moving higher. In this slide, you can see that even though our long-term objective is higher, we would still have looked for shorts throughout these 10 to 15 days. Only after the short-term draw on liquidity was reached should we have looked for taking longs. If you had tried to look for longs the right way, you would have been wrong during this entire period. However, now because you understand this concept, your decision-making process would have been much more informed, mechanical, and objective. Your priority would have first been to look for short trades and then look for long trades. This demonstrates the power of understanding the types of draw on liquidity, and I'm sure by now you grasp this concept well. Moving on, next up is the long-term draw on liquidity. In this slide, we'll discuss what long-term draw on liquidity is, what it means, and how to use it effectively to aid in our analysis and executions. Long-term draw on liquidity focuses on major, significant moves and expansions. It helps you identify where the price is heading in the bigger picture when you zoom out, beyond immediate market reactions and movements. We use this understanding to anticipate where price is likely headed or could potentially go within a broader narrative. Essentially, it guides us on larger moves on the higher timeframes, like the daily, weekly, or monthly. As discussed earlier, short-term draw on liquidity helps to pinpoint immediate market reactions and movements, such as retracement profiles and rejections of highs and lows. In contrast, long-term draw on liquidity involves expansions and reversals, showing where broader, major moves are aiming to reach. It offers a perspective on the bigger picture of market movements and where it is likely to head. Long-term draw on liquidity helps to anticipate and determine where price might expand to after completing smaller moves like retracements and pullbacks. This understanding allows you to target larger liquidity pools like higher timeframe objectives that the price is aiming for. It enables you to anticipate and locate the larger liquidity pools the market seeks to tap into. In summary, short-term draw on liquidity helps with immediate smaller moves within the current market profile, while long-term draw on liquidity provides guidance towards the major, integral market decisions. This sets the stage for major expansions and broader narratives. Knowing both is essential and important depending on the time frame that you are working with. Each specific time frame has its own short-term and long-term draw on liquidity, and you need to determine them individually. For example, a weekly time frame may have its own short-term and long-term draw on liquidity, as will the daily time frame, and so on. Awareness of all of these is crucial. Moving on to the next slide, here's how you can establish and determine long-term draw on liquidity using order flow and market structure. This price action can occur on any time frame. If you determine the order flow to be bearish and see that the price has recently been rejected below a high and created a retracement profile, and the retracement profile has ended, then the next major draw on liquidity would be the low that the price has formed. It really is as simple as that. The first draw on liquidity is the low that the price has created. In these cases, where price rejected above highs, you'll often find a CRT at that swing point, which initiates the top and starts the move downward. Your first draw on liquidity would be to target that specific CRT low. Once the CRT is broken, it or the candle range will be treated as an order block. Price will test it and then expand lower towards its major draw on liquidity, which is represented by this low right here. Moving on, right here, you can see that after this rejection of the high in this bearish order flow, price expanded lower towards its major draw on liquidity, which is this low right here. Here's another graphical representation. In this example, you can see a bullish institutional order flow. We know this is a bullish order flow because price is consistently making new higher highs and higher lows. Additionally, price is rejecting below the lows and breaking above the highs, which clearly indicates a bullish order flow and a bullish market profile. In this type of price action, the short-term draw on liquidity is always the lows, as that's where the retracement profile might end. When price rejects below the low, takes out and purges the liquidity, the long-term draw on liquidity is the higher highs that price makes. Where major movements occur, once smaller moves like retracement profiles are complete. Let's say this is the weekly chart. You're observing weekly price action, and each swing represents significant pips of data. You'll see the price has rejected below this low to form its immediate short-term movement, reaching the short-term draw on liquidity. Now that this short-term draw on liquidity is reached and the retracement profile is ended, the next major draw on liquidity and objective for price is to reach the high. Along with that high, you'll almost always notice a CRT or candle range at the point of the low's rejection. In this case, your initial target liquidity would be the CRT high, and after that, the next draw on liquidity will be the higher price that price is formed, representing your long-term draw on liquidity and where the major expansions and moves are likely to occur. Moving on, right here you can see that the price expanded higher towards this high to reach the long-term draw on liquidity. Moving on to the next slide, here we'll discuss how draw on liquidity can present itself in different forms and the various types that draw on liquidity can take. You'll also see the different entities that can serve as draw on liquidity for specific timeframes. Here is a list of different forms that could potentially be used as draw on liquidity depending on the framework we're working with and how we are determining our draw on liquidity. The first and perhaps most important form of draw on liquidity is range highs and range lows. This is the primary type of draw on liquidity and the simplest. There are no complicated entries or details to consider. You simply need to determine the range high and range low, then wait for one extreme of the range to be purged and manipulated at a key time. Once this occurs, your next draw on liquidity becomes the 50% or equilibrium of that range, and eventually the opposite extreme of the range. The second most important form of draw on liquidity is CRT, or candle range highs and lows. You will consistently identify candle ranges at swing points, range highs, and range lows. In these scenarios, candle ranges nearly always provide clear directional cues on where the price wants to go in both the short term and the long term. So it's essential to be aware of this. You can use candle ranges highs and lows as potential draw on liquidity on your respective time frame accordingly. Another form of draw on liquidity is higher time frame key levels. Market dynamics work in such a way that price consistently moves between higher time frame key levels. It will test one of the key levels and then make a major move towards another. Both short-term and long-term draw on liquidity initiate and conclude at these higher time frame key levels, so they can serve as draw on liquidity to refine and anticipate where price might be heading. Another form is the discount and premium zones within a dealing range. If you have studied my dealing range chapter, you'll know that every market has a dealing range with two halves, the discount and the premium. Based on the order flow and the market profile you're working with, these halves will have different characteristics. For example, if you're working within a bullish order flow, the short-term draw on liquidity will be the discount or equilibrium region of that dealing range or expansion swing, while the long-term draw on liquidity will be the premium region of the dealing range or a key level within the premium region. This approach refines your draw on liquidity. In a bearish order flow, the premium region would serve as your short-term draw on liquidity, while the discount region serves as your long-term draw on liquidity. Moving on to the next slide, we're going to discuss how to determine draw on liquidity. This is the most important part of the chapter. While we've already covered its intricacies, this section focuses on how to actually determine the different forms and types of liquidity, along with the concepts that assist in the process. Although the process might sound straightforward, There are several details and nuances involved, and you need to be aware of these to make informed decisions. This will help you anticipate and determine both short-term and long-term draw on liquidity. To determine draw on liquidity, we use the following concepts. First, we use market profiles, which help us identify the type of market profile that we're dealing with. Second, institutional order flow assists in determining the market structure, whether it's bullish or bearish order flow. Third, we apply candle range theory, or candle ranges, which we combine with the first two concepts to assist in determining major draw on liquidity. Last but not least, range dynamics, dealing ranges, and key levels, specifically higher time frame key levels. They help us anticipate and determine draw on liquidity. Currently, the two main and most important concepts to use initially for gauging and assessing price are market profiles and order flow. You'll align these with higher time frame key levels and dealing ranges. When combined with candle ranges and range dynamics, this approach leads to a refined and objective draw on liquidity and provides a more accurate directional bias for your asset or instrument. Moving on to the next slide, in this part of the chapter, we'll discuss how to actually integrate these concepts to determine our draw on liquidity and how it's applied. Knowing these concepts alone is useful, but their true purpose and function are realized when we understand how to properly integrate them. The integration itself is a detailed topic, and I can't fully explain it here. I'll make sure to cover it in a separate, dedicated chapter, but let me briefly outline how it's done. When all the concepts I mentioned earlier are accurately and logically integrated with a cohesive framework, you'll then be able to accurately and precisely determine your draw on liquidity. To assist with this, you'll use if and then logic. I did make a full video on this. For example, if the order flow is bullish, then start by applying the hypothesis using the if matrix. If the order flow is bullish, if the price has rejected below a low, if the market is in a retracement profile and it's almost complete, and if a candle range is present. Then based on all of these if conditions and hypotheses, the outcome for price would be to first target the candle range high as the draw on liquidity. Eventually, the opposing end of the range, or the swing high, would become the long-term draw on liquidity, indicating an expansion profile to the upside. This is a graphical representation of the hypothesis. The order flow is bullish, we have a rejection below a low, and you can see there is a CRT or candle range present. Based on all of these factors, our draw on liquidity is the first candle range high, followed by the swing high according to this framework. Moving on, here you can see that price reached the long-term draw on liquidity using that framework. We determined our draw on liquidity by applying concepts like order flow, dealing ranges, candle ranges, and market profiles. We then combined and integrated these concepts using if-then logic to help us determine our draw on liquidity. That's how you will approach it. Moving on to the next and final slide, here you can see that the long-term draw on liquidity is used for expansions and major reversals, whereas short-term draw on liquidity is used to anticipate retracements. Now, to see examples of this entire process, you should look at my trade breakdowns, where I demonstrate the process in the real markets and show how I execute trades based on it. Be sure to take a look at those on my Twitter and also in my Telegram. They will help you understand this concept even better. Reverse engineer every trade I've sent in. That is how you will determine draw on liquidity, and this is what draw on liquidity is. Traders, I hope you did understand this video. If you have any interesting ideas or some questions, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames in Trading. Once you're satisfied with the backtesting results, be sure to forward test your favorite strategy on a demo account. Only after that can you trade with it on a live account. If you haven't done so already, please consider liking this video and subscribing to my channel to not miss out on future content. I do upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. Thanks for watching. Till next time, happy trading.